สวัสดีครับ Sorry. How have you been? Tired? Me too. Okay. Can you wait to take a break? Alright. Sorry about that. Today we are going to continue our discussion about capital structure, still capital structure, but we are going to move to another type of financial decisions that is called distributions to shareholders. And if you take a look at our diagram on page 2, you are going to see that after the firm generates free cash flows, there are many ways where the firm can use the free cash flows. For example, the firm may pay interest or repay the principal, and next will be the decision whether to pay out part of free cash flows as dividends. And also the other type of cash distributions to shareholders is called stock repurchases. Previously, stock repurchases were not allowed in Thailand, but currently firms are able to repurchase their stock back. So we are going to study this into details too. So after spending free cash flows through these four ways, if free cash flow is still available, the firm may decide to keep that free cash flow in the form of cash or transfer idle cash to short-term investments, okay? And then withdraw or sell the marketable securities when it needs cash in the future. So now our topic today is here, whether the firm should pay out money or not. And then what type of form, what form of distributions should the firm follow. There are a few issues when we discuss this topic. I summarize everything in topic 1 here. First question. We are interested in the question that distributing cash flow to shareholders can affect the firm's value or not. So that is the first issue. Can a firm increase its value through its choices of distribution? And first of all, does the level of cash distributions matter at all? Or the firm may pay just only small amount of dividends, for example. Second question, does the form of distribution matter at all? There are two major forms now. Indeed, there are more, alright? But I'm going to talk about cash forms first. Cash, dividends, and stock repurchases. Do investors prefer one type of cash distribution to the other? Right? We are going to study this as well. And then, do investors expect stable stream of distributions? Is it okay if the firm doesn't care about the stability of distributions, just pay out a lot of dividends when it earns a large amount of earnings, and then does not pay out anything at all when the firm incurs some losses? Is this better than just keeping the amount of dividends in each period stable? Right? Second, yes.
Level here you mean like amount, right?
The level, yes. Second question. There are many types of common stockholders, and some of them may prefer one type of cash distributions, but the other may prefer the other type our question is that do several groups of shareholders prefer one form of distributions to the other? Okay. To be more specific, do investors prefer cash dividends to capital gains? Right? Do common stockholders prefer dividends to capital gains and vice versa? Now, dividends are good for investors because they are part of the returns, right? However, it is possible that the firm may use dividends as a signal to the stock market about the prospects of the firm in the future. So we are going to study about the signaling effects of cash dividends as well, right? So you need to review basic principles of the dividend policy from FN311, alright? In this class, we are going to jump to a more advanced topics that were not discussed in FN311. So I'm not going to talk again about how many types of dividend policies, for example, constant payout ratio, residual dividend policy, and so on, okay? We are going to move to the theories that explain the distribution policies of the company, okay? However, I may review some of the topics that I just mentioned in this lecture notes too. Let me think first. I think I better jump to page 4. And then we're going to come back to page 3 later. So go to page 4. Now, please make sure that the central idea of this topic is still related to the firm's value. It's still related to the firm value. That is the theme of our course. The theme of our course, okay? And you can see that we are going to determine, or we are going to find an optimal distribution policy here. Whether there is any optimal distribution policy or not. Alright? So we are going to pay attention to the fact that the best distribution policy should lead to the maximization of the firm's value, or the maximization of the stock price, or the minimization of the weighted average cost of capital. Very similar to the objectives when we discussed the capital structures earlier, alright, before the midterm. Then, if we have this in mind, we are going to discuss 2 types of returns common stockholders expect to get from holding common shares. Dividend yield versus capital gains yield, by just taking a look at the Gordon model here. So I'm going to rearrange this expression a little bit. So from this Gordon model, I am assuming that we may not be in equilibrium, doesn't matter. The intrinsic value of the stock price is equal to D1, the expected dividend next period, divided by the cost of equity minus growth rate, right? So if I rearrange this a little bit, this is what I'm going to get, D1 over P0 plus T. And this is your total expected return, and this is your expected dividend yield, plus expected capital gains yield. Right? This is also equivalent to the growth rate of dividends, okay? No need to explain more. So you can see that investors, common stockholders here expect to get both dividend yield and capital gains yield. Now, from this expression, if the firm pays a lot of cash dividends, the expected dividend yield will be high. However, there's little money available for the firm to reinvest, and therefore the growth rate of the firm will be very slow, and that makes the expected capital gains yield to be small. On the contrary, when the firm decides to pay a little amount of cash dividends, expected dividend yield will be small. However, since the firm retains a large amount of money for the reinvestments, right? If the projects are profitable, the firm may experience a large growth, and therefore stock price will rise at a very, very fast rate, and therefore expected capital gains yield will be high. So now, which type of return do common stockholders prefer? Right? Expected dividend yield or expected capital gains yield, or they are indifferent between these two types of returns? That is the question. Therefore, we are going to discuss the first model again. Would you please switch the names? It should be called Miller and Modigliani now. But it's okay, you call this theory Modigliani and Miller, alright? But I think the sequence of the names are important here. This is their work following the Modigliani and Miller 1958 we discussed before the break, alright? Again, assumptions are similar to the assumptions we discussed before the midterm. Very, very similar. One thing that I would like to mention is that this one. They assume that investors and managers have identical sets of information. So there is no information asymmetry. No information asymmetry. The second assumption that is important is that investors are indifferent between dividends and capital gains. Investors are indifferent between dividends and capital gains. And of course, the last one, there are no transaction costs, okay, no taxes. Now, this theory is called the dividend irrelevance theory. The dividend irrelevance theory. So from the name, you can tell from the name that the dividend policy does not matter. That means that it is okay not to pay out dividends at all. The result will be similar to 100% dividend payout ratio. Doesn't matter. And their reason is very, very simple. Their reason is here. they argue that the value of the firm is determined by only two factors. By only two factors. The first one is the size of the free cash flows, the numerator. The size of the free cash flows. So you may call this factor basic earnings power of the firm. That is the ability of the firm to generate operating cash flows. Okay, the numerator that determines the firm's value. Okay, and the second factor is the riskiness of those free cash flows, the denominator. Right? So let me repeat. Their reason is very basic, and very strong. Basic but strong. The firm values is determined by first the size of the free cash flows, and second the riskiness of the free cash flows. It is not dependent. It is not dependent on how the firm splits the earnings. Not dependent on how the firm distributes free cash flows in the form of stock repurchases or in the form of dividends. Doesn't matter. Okay? That is because investors can create their own dividends at home, and we call this activity we can call the dividends generated by this way a homemade dividend. Homemade dividend. I'm going to explain to you more. Right? So investors are indeed indifferent between capital gains and dividends. Doesn't matter at all. When they want some cash, if the firm does not distribute any dividends at all, they can create their own dividends at home. Look at this diagram. You need to draw the diagram yourself. The first situation, firm, investors. To be more specific, common stockholders. Right? Investors need some cash. The firm does not pay dividends. Right? So this is a situation where investors expect the firm to pay some dividends. However, the firm may have some profitable projects, so it needs some money for investment. Therefore, the firm decides not to pay dividends at all in this period. Right? How do investors react to the decision of the firm not to pay dividends in this case? Investors need some money here. They are going to cook dividends themselves. So a homemade homemade dividends will be created. How? Investors are going to sell some common shares they hold. They are going to sell some shares. They hold, alright? And therefore, they can get money that they want. So a case is closed. Common stockholders investors need some dividends, for example, for spending or whatever. But the firm does not pay dividend. The first reaction from common stockholders is to sell some shares so that they can get money. That's all. On the contrary, this is a second situation. The firm decides to pay some dividends. Or you may use an extreme example. The firm decides to pay 100% of earnings as dividends. However, in the second situation, common stockholders do not need cash at all. They do not need cash at all. However, they cannot stop the firm from paying dividends, right? So the dividends are going to be distributed anyway. So you can see that there is an excess amount of cash. There's an excess amount of cash here. So investors are going to get rid of the excess cash. How? Many ways. Buying more stock of the same firm. Buy more shares of the same firm. Or buy more shares of other firms with similar risk. We would like to be able to compare two situations, right? So let me repeat what happens in the second case. Investors do not need cash, not at all. However, the firm decides to pay dividends. So investors are going to get money more than they want. So they are going to get rid of the excess cash. How? For example, buying more shares of the same firm, or buying some shares of other firms with a similar risk. Again, the case will be closed here. So when there is a deficit, when there is a cash deficit here, stockholders can create dividends themselves. In the second case, when there is excess cash, investors are going to get rid of the excess cash. So everything is perfect now. This is their reason. This is their reason, right? So the conclusion, I'm going to wait because I'm going to compare the first three theory on page 6 anyway. So turn to page 5, please. The second theory. Now, the second theory is called the bird in the hand theory or hypothesis. And the proponent of this theory is Lindner and Gordon. They worked separately, all right? So there were two papers. For the Miller and Modigliani, there was only one paper. They worked together, all right? Now, this is the idea. A bird in the hand is worth more than 2 or just equal to 2 in the bush? Not quite sure. Equal to or more than 2? More than 2? Or equal to? More than 2? Are you sure? A bird in the hand is worth more than 2 in the bush. Why do you say that? Because something is in your hand, you can see it for sure, right? You get it for sure. But in the bush, you may just You are curious whether there are many birds in the bush or not. You are not quite sure yet. So we are talking about riskiness of distributions in this case. They argue that dividends have lower level of risk than capital gains. Capital gains are return that must be captured in the future, which is still uncertain. It depends on the rise of the stock price, right? So in the future, the stock price may drop. Therefore, your expected positive capital gain may become capital losses. But if the firm announces dividends, you are going to get them for sure today or a few days in the future. However, if you would like to reap the capital gains, you may need to wait for some time and still with some risk because stock price may drop anytime. So you may not have any capital gains at all. Alright? So by using this reasoning, they suggested that the higher the payout ratio, the better. In the sense that if the firm, this is the prediction of this model. If the firm payouts high dividends or large amount of dividends, the riskiness or the risk borne by common stockholders will be small. So the cost of equity will be low and the weighted average cost of capital will be low too. Other things constant. And the value of the firm will be high. On the contrary, if the firm does not pay dividends at all or the dividend payout ratio is very small, risk will be high. The cost of equity will be high in this case, and therefore the weighted average cost of capital will be high too, driving down the value of the firm. So this is the prediction of this model. Alright? So investors are going to value high payout firms more highly than would require a lower return to induce them to buy stock. Okay? So the conclusion is very simple. Pay high dividends according to this model. Pay high dividends, alright? Now, can you still recall that high payout ratio are able to reduce agency costs of equity by a high dividend payout ratio may reduce the agency cost of equity, by how? Why did you say that the higher the dividends amount, the lower the agency cost of equity? Other things constant, of course. Because by paying out a large amount of dividends, the free cash flows will be small or large? Small. Therefore, this closes an opportunity for managers to spend the free cash flow wastefully. We just discussed this, right? In lecture note 1.1. So basically, by paying a lot of dividends, this may be able to reduce the agency cost of equity because this will deprive managers of cash to waste, and on top of that, causing the managers to have more scrutiny, monitoring, more monitoring by going to the external capital market, more frequently. So basically, you just shareholders can get rid of free cash flows out of the hand of managers, right? Here? Yeah, I'm trying to repeat using other words. But if you like to copy this, that should be okay. Here, you can deprive managers of cash. Get rid of cash out of the hand of managers. So you just get excess cash from the hands of managers so that they cannot spend the cash wastefully. Managers cannot spend the cash wastefully. And this mechanism also forces the managers to go to get money from the external capital markets more frequently. And therefore, you just ask indirectly the capital markets to monitor managers' behavior, right? If you still remember, when we discussed a little bit about I forgot the word, the due diligence, that's it. When analysts or financial advisors or underwriters come to visit the company, right? They come to talk with the managers, and therefore they try to get information so that the value of the stock can be determined or the interest rate can be determined if the firm wants to borrow. Yes.
You also say the cons of doing this is gonna make the WACC increase it. Then wouldn't you also make WACC in the long run?
That is correct, because if the firm does not have internal capital, right, then it is going to issue or common shares or borrowing. It depends. So there's a trade-off between letting managers have a large amount of cash, and then they may be spending a lot of money buying something that is not worth at all. Alright, so you need to trade off anyway. By doing that, the incremental cost of issuing common stock, for example, may be smaller than letting managers spending this excess cash wastefully. Right? That could be another issue that you need to determine. Okay, so let me repeat this one. The thing here is that when we discuss about the cost of equity, someone answered that borrowing a lot can also place some discipline to manager, because in that case managers are going to work harder, because if the firm goes bankrupt, then everyone will lose his and or her job, right? And paying a lot of dividends is one way that you can also discipline managers. Since in this case, managers are going to behave well, trying to put more more effort on the interest of common shareholders. Okay, yes.
What do you mean by going to external capital?
Because when excess cash is not available anymore, assuming that an investment proposal comes up, then the firm may need some money. So there's no internal money anymore because cash has been distributed to shareholders already. Therefore, if the firm needs some money for the new project, right, the firm needs to go out to get money from the external markets. For example, borrowing or issuing more shares. So by borrowing or issuing more shares, then other people are going to come in and then monitor managers, right?
You're saying right now is contradicting because earlier you say that the higher dividend payout, the higher the firm value. But it turns out when you pay a lot of dividend, you take out the cost of cost of borrowing, like floating cost, and the higher rates you pay, higher the ACC, which is gonna reduce the firm value. So should it actually contribute that? But in the hand, holistically, higher value with higher dividend.
No, in this case, it is consistent. It is consistent with the fact that by paying a lot of dividends, the firm can reduce a large amount of existing cost of equity, because this is also called the existing cost of free cash flows, if you still remember. Okay, very similar. So here you can reduce the existing cost of equity, which is the existing cost of free cash flow. The existing cost of free cash flow. All right. Now, Miller and Modigliani fight back. They call the bird in the hand hypothesis the bird in the hand for lazy. A misunderstanding. A misunderstanding. This is how Miller and Modigliani argue that Lindner and Gordon misunderstood the concept of the dividend here. They argue that many investors, if not most, but many investors will reinvest the dividends in the same firm or in other firms with similar risk anyway. That is one thing. Like the first diagram that I draw to show you their basic argument. When investors do not need dividends, but the firm pay out dividends, right? They are going to buy some shares of the same firm, okay? Or other firms. Many investors, if not most, do that anyway. In addition, the long run riskiness of the firm, does not depend on how the firm pay cash to shareholders, or how the firm see the cash inflows expected to get from the firm, but on the volatility of free cash flows that the firm can generate from its assets. Listen to me carefully. We are talking about riskiness here. But Gordon and Littner argue that the riskiness is in the form of distributions, because investors perceive capital gains as returns with a higher level of riskiness than cash dividends. However, Miller and Modigliani say that the riskiness of holding stock depends on the riskiness of free cash flows generated by the firm's asset. So basically, they just go back to their basic reasoning. Okay, that is the numerator, basic earning powers, size of free cash flow, and second, the denominator, factor that determines the firm value, the riskiness of free cash flows. So the risk should be the risk of free cash flows generated by the firm's asset, not the risk of the types of returns. That is the counter argument, okay? However, if we see the dividend relevance hypothesis, the conclusion is one thing, that dividends are not affecting the firm's value at all. But for the second model, the bird in the hand theory, the best or the optimal dividend policy should be 100% dividend payout ratio. Third theory, they introduce the tax into the picture. This is called the tax effect or the tax differential hypothesis by Lisenberger and Ramaswamy in 1979, I think. Do we need to remember the names of the authors? A little bit, please. Did I pronounce his name correctly? Ramaswamy? No? Yes, I think I did. Now, things will change according to their hypothesis now. We are relaxing one assumption. That is tax, alright? We are assuming that investors here, common stockholders, pay taxes on dividends and capital gains at different rates. In many countries, tax rates on capital gains and dividends are different, alright? This is just one example. Suppose there are two firms, ING. I is for income. This firm pays a lot of dividends. G is a growth stock. It does not pay a large amount of dividends. However, the stock price grows at a very fast rate. So the capital gains yield is very large. Take a look at two firms. If we assume that the risk of these two firms are similar, therefore the total return required by common stockholders for these two firms will be the same. I am assuming that this is equal to 15%. I'm going to complete the table in a minute, okay? However, there are two different tax rates. For dividends, the tax rate is 40%. For capital gains, the tax rate is 28%, right? So I am assuming that for firm I, the dividend yield is 10%, the capital gains yield is 5%, total return 15%. Similar to the total return of firm G. But for G, the growth rate is huge, dividend yield is small. Okay. Now, take a look at the final numbers. 3. Okay. 1, 2, 3, 4. So this is for firm I, this is firm G. Okay. Now return before tax minus tax, and this is the after tax one. Before tax minus tax, and this is the after tax one, right? Next, 10%. Now you expect to get 10% dividend yield because the personal tax rate for dividend income is equal to 40%. Therefore, there is a deduction of 4%. So the after tax amount will be 6%. For the capital gains yield, this is 5%. You need to give some money to the government. This is equal to 28%, right? So this is 1.4. If my number is incorrect, please let me know. 2.8 times 5, 4, 1.4. So this is 3.6%. Total return 15% minus 5.4%. So you are going to get only 9.6% of the taxes. 9.6%. For firm G, the calculation is similar. Starting with 5, 10, 15. So this is 40%. The deduction will be 2. So the after tax one will be 3. 2.8, 7.2%. 7.2%. So the deduction here will be 4.8%, and this is 10.2%. Right? Now, so compare these two numbers. If you are investors of these two firms, which one is better? G. Because the after-tax total return is larger. This occurs because tax rates are not the same. And in many countries, the tax rate for capital gains yields are smaller than those on dividends. Usually this is correct, but not always, not all countries, all right? But in most countries, this is a fact. Therefore, because of a tax differential like this, investors are going to prefer one type of distributions to the other, that is capital gains. This is the tax effect. So investors are going to perceive distributions in the form of capital gains better returns. I don't want you to we can conclude that we can take this and link it to the risk as well. So here, common stockholders are going to require a higher rate of return when the firm pays a large amount of dividends, because they don't like the firm to do that. By saying that a high rate of return, this is similar to saying that they try to drive down the stock prices, right? When the firm pays a large amount of dividends, because when they get the dividends, they are going to pay a larger amount of tax, right? So this is the conclusion of the tax differential hypothesis. Now, I have one note below the table. What if stock G is never sold? I ask you this question because when we talk about the capital gains tax, you are going to pay this tax when you sell the stock only. So if you still hold the stock, if you hold the stock, you do not pay the tax at all. So if you plan to hold stock for quite a long time, then the effective capital gain tax rate will be even smaller than 28% in this case, right? Let's say you hold it for 40 years and then you just give, of course, 40 years or 50 years. Then the effective capital gains tax rate will be, of course, smaller than 28% because the effect of the time value of money. Okay.
Which means the bubble will increase even further.
It is even supporting the third hypothesis that investors will prefer capital gains to dividends because the effective capital gains tax rate is even lower than the effective dividends tax rate. Okay, a quick quiz. There are two diagrams here. The left is the stock price on the y-axis, and then the dividend payout ratio on the x-axis. Zero dividend payout is here. 100% dividend payout is on the right. Okay. So can you label what lines correspond to which hypothesis? I'm going to choose the middle one first because it's the easiest. This is the dividend irrelevance. The dividend irrelevance. So stock price, dividend payout ratio, this one is dividend irrelevance. How about the black one up here? This one should correspond to the bird in the hand or the tax differential. Should be the bird in the hand, right? The higher the dividends, the higher the firm value, and therefore the higher the stock price. How about the bottom one? Of course, the tax differential. Okay, now move to the cost of equity. The cost of equity, RS. This one will be the dividend irrelevance. How about the top one? Should be the tax differential. Right? Tax differential. And the bottom one should be the bird in the hands. Okay? And the weighted average cost of capital will be similar too. Now, implications. Dividend relevance. Any payout policy is optimal because from the two diagrams here, it doesn't matter. It doesn't matter at all whether the firm does not pay dividends at all or it pays 100% dividends. The firm value is still the same. So any payout ratio is optimal. Second, for the bird in the hand, the firm, so the recommendation for the second hypothesis is that the firm should set a high dividend payout ratio, right? The optimal dividend payout ratio is 100%. D is equal to 1. And on the contrary, for the tax differential, set low payout ratio. The optimal dividend payout ratio is D is equal to 0%. Do not pay dividends at all. Retain all the money, reinvest in profitable projects, and then keep the firm growth at a fast rate. So investors are going to enjoy capital gains yield because personal tax rate on capital gains is smaller. Okay. Now, when the financial researchers used real financial data to test these three hypotheses. This is the result. The result is mixed. In the sense, this means that there's no one particular hypothesis that supports the real financial data all the time. Okay, in some countries, one model may be consistent with the actual data. In other countries, the other models may be better. So the results are still mixed. Therefore, you as a manager should use your own judgment whether you are going to proceed with the first one, the second one, or the third one, or the new ones that are going to follow in a few minutes, okay? Right? So, any questions with the first three models? Next, number four. This is called the signaling or information content of the dividends by Miller and Rock, Pattarachaya, and John and Williams. Now, we need to relax one more assumption. That is the assumption on symmetry. Now we are going to assume that investors and managers have different sets of information. Managers have more information regarding the prospect of the firm than external investors. Therefore, the behavior of managers will be observed by investors. And then they are going to interpret the signals that will be sent by many financial decision makings. And now we are talking about paying dividends. Okay? So they all argue that managers adjust the amount of dividends to signal the prospect of the firm. Do you still remember one fact that dividends are sticky? What does this mean? Dividends are sticky.
Is it like managers really tend to change the policy?
Correct, because
Like if they have done dividend, for example, that's so fast in the market and like drive the stock price down.
okay, yeah, very close. I'm going to extend her analysis a little bit. She said that managers are reluctant to cut dividends, all right, because the dividend cut may bring down the stock price and probably more than proportional. The thing here is that managers are not going to increase dividends if they are not sure about the fact that they can maintain the new level of dividends. Let me repeat. Managers are not going to increase dividends if they are not sure whether they can keep that high dividends in the future. Because like she said, if today, if this year the dividends was 1 baht per share, and then managers think that they can increase the stock price by announcing 2 baht per share of dividends. And then they decided to increase the dividends to 2 baht. Right? Of course, the reaction from the stock market will be positive. I am assuming first that this is a positive signal. Because investors are going to interpret an increase in dividends as a stronger financial position of the firm in the future. And next year, investors are going to expect to receive 2 baht at least. If the managers cannot maintain this new level of dividend distributions, there will be a negative stock price reaction, and probably will be worse than managers can expect. Okay, because this is like a dividend cut, and when there's a dividend cut, investors are going to treat this as a negative signal. Okay, worse situation, worse financial position in the future. So that's why I mentioned the fact that dividends are sticky. If you are not sure whether you can maintain the new level, don't increase dividends yet. Alright? You may announce extra dividends instead of regular dividends, so that you can give a signal to common stockholders that an increase in dividends is not a regular one, but it is an extra amount. You should not expect to get this amount in the future. Okay? This is clear, right? So, by this fact, whenever there is a dividend increase, the stock price will react positively, not because of an increase in the dividends per se, but the signal embedded in the announcement. Right? Investors are going to interpret an increase in the dividends as a good signal. That is because if the firm by the managers is not sure to maintain the new level of dividends, the firm is not going to increase the dividends. So by announcing an increase in dividends, that is a signal that the ability of the firm to generate future operating free cash flows is stronger. One more thing here. When I talked about an increase in dividends, I mean a higher than expected increase in dividends. Higher than expected. Because if everyone knows already that the firm is going to increase 1 baht of dividend in the next period, right? Stock price will be reacting positively immediately. So when the time comes and then the firm increases the dividend according to the projections from the stock market, there should not be any increase in the stock price anymore, because the stock price has absorbed the news already. So here we are talking about a higher than expected increase. Okay, and on the contrary, when we talk about a dividend cut, this is similar. Should be the higher than expected dividend cut. Okay, because if an increase or decrease can be forecasted by stock market already, then there should be no stock price reactions anymore. Should be new information. Yes.
Higher
Like everyone in the market expect that this period, last period, dividends were 1 baht. But analysts and other investors forecasted that the dividends at the end of this year, will be 2 baht. So the news about this increase has been absorbed by the stock price already. At the end of this year, however, if the managers announced that the dividend this year will be 1.25 baht, that 0.25 baht is a surprise. So there will be a new positive reaction from the market, right? Everyone forecasted 1 baht increase in dividend. However, when the time comes, the actual dividends are 1.25. That 0.25 baht has not been expected before. So that is a surprise. That is a surprise. This is similar to a dividend cut, right? If, for example, last period, the dividends were 1 baht per share. Next period, everyone in the market expects 50.5 baht, a dividend cut, right? So this piece of information has been absorbed by the stock market price already. So when the times come, instead of paying 0.5 baht, the firm announces only 0.25 baht. That is a surprise, but it is a negative surprise, right? So the price will drop according to the new information. Okay. So let me conclude. This is a reason according to this hypothesis. Okay, investors view dividend changes as signals of management views of the firm in the future. And usually managers paid to cut dividends. Manager paid to cut dividends. So they won't raise dividends if they don't think that an increase will be sustainable. All right. So they must make sure first before they raise dividend. So by using this background, dividends announcements are therefore signals from the firm to the market. Next, clientele effect. The firm may have different groups of common shareholders. So basically, the firm may have different groups of different clientele. Some investors prefer dividends because they may be retirees whose only cash inflows is in the form of returns from investing in financial securities like dividends, interest income, for example. So they rely on dividends. Right? So they prefer dividends. Or some type of investors may be exempted from paying taxes from receiving dividends. Not many, but some of them may be exempted, all right? So this group of investors are going to invest in firms with high dividend payout ratios, right? Basically income stocks. Other investors may prefer capital gains more than dividends. So they are attracted to firms that do not pay a large amount of dividends. they would prefer stock like stocks G, growth stock, okay? Now, if you take a look at the current dividend policy, of any particular firm, you can determine the clientele or the different groups of investors right away, because the current dividend policy will, like I said earlier, it will attract investors, of course, different groups of investors depending on types of dividends that the firm is using, right? Firms that pay large amount of dividends will attract investors who prefer dividends and vice versa. Therefore, if there's a change in a dividend policy, if there's a sudden change in the dividend policy, there will be a change in the clientele. For example, a firm that pays high dividend before switches to the other type of dividend policy by paying a small amount of dividends. Current common stockholders are going to be very disappointed. Therefore, they are going to sell common shares of this firm. Okay. Common stockholders who prefer dividends will sell shares of this firm and look for new common shares of other firms that pay high dividends. And new group or new clientele, new group of common stockholders who prefer capital gains more will come and buy shares of this firm. Let me repeat. I was saying that take a look at one firm that pays a large amount of dividend, but suddenly it decides to change its dividend policy, all right, from paying a large amount of dividends to a small amount. What will happen to the clientele? Investors will sell the stock of this firm and buy new shares of other firms that pay high dividends. And on the contrary, new common stockholders who prefer capital gains are going to buy the shares of this firm. Okay? This is what we expect. Things are not that simple. I am going to clarify very slowly, alright? Now, the firm will not change its dividend policy frequently. The firm will not change its dividend policy frequently because that action is very costly to the firm. I am not saying that the firm cannot change its dividend policy at all, alright? But I say that the firm will not change its dividend policy frequently because that is very costly to the firm. Why?
Because when shareholders sell the stock price declines dramatically.
Yeah.
And then investors for the stockholders like that.
That's one thing, because the first thing is that you are correct. The first thing is that current common stockholders are going to sell their shares right away, but that costs the shareholder as well. They need, by selling the shares, right? They need to pay the brokerage fees. So put it by using simple words, they will be very angry, right? That the firm forces them to sell the stock, okay? To sell the stock. So they need to pay their brokerage fees. That's one thing. Of course, the price of the share will be lower because of the sale pressure, On top of that, earlier I said that a new group of investors are going to come in. However, it is not always correct to assume that the current shareholders can sell their shares easily. Not always. They sell their share, they drive down the price of the stock, but it doesn't mean that their shares can be sold. Put it in other words, it is not a guarantee that a new group of common stockholders will come and buy the shares from the current shareholders. However, a sale pressure drives down the price of the stock already, right? So if a new group of shareholders do not come in to buy all the shares that are sold by current shareholders, the firm is not going to get the new group of shareholders. So if you imagine that they change, the firm changes the policy every year. This is a chaos. The result will be the drop in the price of the common share. And the drop will be too much for the firm to handle. That's why I said earlier that by changing the dividend policy very frequently, this is very costly to the firm. Right? It is costly to current shareholders too, right? Because they are forced to sell the shares, so they need to pay the broker's fees. And on top of that, it is not a guarantee, like I said earlier, that the new group of investors are going to buy the shares that are sold by current shareholders. So this theory suggests that the firm is not going to change its dividend policy frequently, not at all. That's too costly to the firm. Okay. Now, is there any empirical evidence supporting this theory? The answer is yes. Okay. From many pieces of financial research, there is some evidence that there is in fact a clientele effect, right? Now, one thing that you should take a note here is that from our discussion, clientele effect will impede the dividend changes. That is because by changing the dividend policies very frequently, it is too costly to the firm. Any questions regarding this? Yes.
So that's the conclusion and it's not passive.
I'm sorry.
That's the conclusion.
Uh, the conclusion. Yeah, you can use the word conclusion or an invitation. An invitation. All right. Next hypothesis. Catering hypothesis. Catering hypothesis. Now, I am not going to go into detail regarding this model. This is the newest one. This is the newest one. The thing is that this is very simple. Investors determine how much dividends the firm should pay. All right. So basically, the demand is created by investors. The demand in dividends are created by investors. The firm needs to learn about the preference of investors, the preference of the investors. If the firm knows that at this moment investors prefer dividends to capital gains, the firm is going to distribute a lot or a large amount of dividends. But in other times, when investors do not like much of dividends, the firm is going to pay a very small amount of dividends. One thing that I am not telling you is that how does the firm know? That's too difficult for this course. So let me repeat the concept here. Catering. It is like a food service, right? It's similar to a food service. So whenever you are hungry, I'm going to serve the food to you. So if the firm knows that at this moment investors give a high value to the firms that pay high dividends, then the firm is going to pay a large amount of dividends. In other times, when investors put a high value to stocks that pay a small amount of dividends, then the firm is going to do it like that. Pay small amount of dividends, okay? That's it. The last one before the break, this is called the incomplete contract model or the agency model. We discussed this already, but I would like to repeat the idea. You may call this one the incomplete contract or the agency model. Incomplete contract or agency model. Recall from lecture note 1.1, it is impossible for the principals to write a contract that is very complete in order to discipline managers. Almost impossible. If you try to write down a contract between you and the agents, right, the cost of writing a complete contract will be very large. Very large, all right? So the contract, the hiring contract, of course, between you and your agents will be incomplete in this sense. And therefore, it is possible that managers sometimes or most of the time may put effort for their own interest, right, instead of yours. Right? So dividends may be able to help in this case. Discussed in detail already at the beginning, not beginning, when we discussed the bird in the hand theory. Right? So the conclusion of the bird in the hand theory and the agency model is similar. In this case, the principals may want the firm to pay a large amount of dividends in order to discipline managers, So monitoring from external capital markets are helpful in this case because the principal themselves may not be able to monitor their agents 24/7. That's impossible, too costly. So by getting rid of free cash flows from the hands of managers, then managers may be more disciplined. So the agency cost of equity may be smaller in this sense. So this last theory recommends a large amount of dividends. So basically, a high payout ratio. The best one will be 100%, right? So that when the firm needs some money, it has to go out and get the money from external markets, and then some people are going to monitor the behavior of managers for shareholders. This is very helpful, especially for public firms where the ownership is very diffuse, not concentrated, diffuse. Only many investors, small ones. Okay, let me take a look at number 4 a little bit. Please take a look at number 4 because this has been covered in FN311. Take a look at number 4 and let me know which one you would like me to explain to you more. Everything? Okay. Alright. Okay, now other factors that may determine the amount of dividends are first, constraints. 1 and 2 are very similar, bond indentures. In some cases, there is a provision in a contract saying that the firm cannot pay dividends if the time interest earned is still below this time, like 10 times, for example. So there is a restriction in the loan contract or in the bond contract that restricts the firm to pay out dividends to make sure that when you borrow money, right, you are not trying to milk the property. Still remember milking the firm, milking the property? So there is a restriction on paying out dividends. So if there is such a clause in the loan contract or preferred stock contract, then you cannot pay dividends. For preferred stock, this is very simple. Preferred must get money or cash flow before common, right? So if you do not pay dividends for preferred shares, you cannot pay dividends for common shares, right? Third, what is the impairment of capital rule? By law, dividends must be paid from profits. They cannot be paid from the firm's capital, share capital. You cannot pay dividends from share capital, all right? This law is designed to protect the corporation's creditors. This law is known as the impairment of capital rule. It says that dividend payments may not exceed the corporation's retained earnings. Let me repeat. The firm must pay dividends from profit or net income. However, the amount of dividends cannot be larger than the amount of retained earnings. Shown on the statement of financial position. Okay. This is called the impairment of capital rule. So even if you have a large amount of cash, however, your retained earnings are just a small number. You cannot pay cash dividends in excess of the amount of retained earnings, right? Two more before the break. Simple one. This one. Just want to finish 3.1. It depends on if you don't have any cash at all, can you pay dividends? No, very simple. So it depends on the amount of cash available, alright? If you don't have cash dividends at all, can you pay dividends?
I think this one goes back after this. No cash, this one gonna
Can you pay dividends if you don't have cash at all? If you don't have cash, can you pay cash dividends? No. Please listen to the second question. If you don't have cash at all, can you pay dividends? Yes. How?
Stock dividends.
Stock dividends, right? Stock dividends are the firm's alternative to pay dividends too. Okay? You forget already. Last one. In some countries, there is a penalty tax on improperly accumulated earnings, meaning that net income that is retained will be taxed too. So if this tax rate is high, the firm may decide to pay a large amount of money, right? That is because of the tax effect. Not in Thailand, of course. There's no penalty tax on the retaining earnings, okay? No tax. In a few countries, I don't remember the countries, but there are some cases where the firm must pay a tax on the amount of net income that is retained. Okay, so see you in 10 minutes.